company is buying it.
Well, I guess we'll see. Like everything else, does it fly?
That's it, right?
For,
we don't know.
And for how long will they fly for? Right. All right, guys. Why don't we go ahead and get started? Matt, thanks again for joining us today for the Mortgage 101. I know Nicole and Liz are a bit more advanced than the 101, so we can adapt and reflect a little bit more based on our attendance.
Sounds good to me. Feel free to put a chat box in if I start to talk about things and you're like, I know, I got it. And we can maybe work through this faster than originally anticipated. Well, Scott, thanks for having me. I'm Matt Blanchard. I work at Academy Mortgage in Beverly, right over on Conan Street. And I'm going to jump in and start. We're going to go through kind of the basics of how we qualify someone. Some of this is very similar to what I do in my first-time homebuyer presentations in terms of explaining how we qualify. And then we'll do a couple more little fun things, some optics stuff, some maybe best practices, Mortgage 101 stuff, just to maybe reiterate from my perspective, from the lending perspective, just to wrap up. We can spend some more time on that. So there are several things we consider when we're looking at a mortgage. There are the three pillars of financing, I call them. It's your credit score, your down payment, and your debt to income ratio. Typically, lending under 620 credit scores, we have trouble with. There's not a lot of options out there. There are some out there, but they don't fit into our conventional guidelines. So we like to see 620 and above, and I'll dive a little deeper in that. And then from there, the better your credit, typically the better your interest rate gets and the better your PMI gets if you've got that. Down payment, we run the gamut. In the old days, you had to have 20% down. Now we can do loans with as little as 3% down. And there are down payment assistance programs out there. If you're a first-time home buyer, you can get help with that additional 3% as well. So the flexibility in our industry has really adapted, realizing that 20% down for most people is an enormous and unattainable number. So what we've done is allowed for less than 20%, but when you own less than 20% of your home, you have PMI, private mortgage insurance, and we'll talk about that as well. So credit score, down payment, and then debt to income ratio. We're going to walk through this. I'll show you a closing disclosure. We'll walk through the fees that people can expect at closing and kind of unpack each one and what it means. And then we'll talk about PMI. And I'm going to give you kind of the tools to do a quick PMI quote on your own, just with a calculator on your phone, and show you how we actually get that monthly number. So if you're on the fly and you're at an open house and someone says, well, I wonder how much my PMI is going to be, you can get a pretty good estimate for them. Or you text your lender. I'll give you a pretty good quick quote too. So the first thing we talk about is credit. And, I get more questions about credit than probably anything else when I'm dealing with a new customer or new client, someone new to the industry. And I love this wheel. I think this is a very, very good way to kind of explain and show how credit is determined. If we consider credit and how it's calculated, the most important thing is your payment history, that you just pay on time, that you don't have lates. The next most important thing is that amount owed. So if you've got $1,000 balance on your credit card, and when I pull your credit, you've got $999 on that, that's negatively impacting your credit score. Ideally, we like to see, your credit utilization under 25 or 30%. And even better if you can use less than 10%. Ironically, it does not help your credit to have a credit card and just have it be zero all the time. You're not building credit. Your clients are not building credit that way. So I tell people, if you've got a credit card that you don't usually use, just use it for gas. Once a week, go swipe it and then pay it off. Just make sure that there's some activity on there because that will help continue to build the credit. the most common thing I get is, oh, should I close my credit? Should I close these accounts? I've got 5 or 6 accounts. It's funny, we look back at when we're younger and the first credit cards we get. I see so many Victoria's Secret credit cards. They're open when, girls are young, and that, they go their first credit card, and people say, well, I don't use my Victoria's Secret credit card anymore, but don't close it yet, because that could be your longest and oldest line of credit. So it's a balancing act when we start to look at these credit reports, and when we talk to people about their credit utilization, sometimes that old credit card that they never really use is not the one we want them to close, if we want them to close one at all. So payment history, most obvious. Don't miss your payments. Don't max out your credit cards. The length of credit history. I've got people who've only had student loans and maybe one credit card, and they've never missed a payment, but they have mediocre credit. Well, that's because they just haven't built it up over time. It does take time. This one right here, the 10% type of credit use, as you go through life, there's installment payments, there's revolving payments. An installment payment is like a car loan. You pay the same amount every month, and you have a term. A mortgage is an installment payment. Revolving credit is a credit card. $1,000 limit, you can use up to 1,000 and you can pay it off. And it's flexible spending. So we like to see more types of credit used and utilized well. That's a smaller portion. And the last one that I'm very concerned about lately is inquiries. There's this little window when you're pulling credit. They say it's about 14 days where you can pull your credit several times and it doesn't impact your credit score. That one pull, if you pulled it 3 times, it's all going to report as one pull. What we don't like to see is like 5 or 6 credit pulls throughout the year. Then every time you pull the credit score comes down and down. They call them habitual credit shoppers. You don't want to be someone who's applying for everything all the time. That will lower your score. The reason I'm so concerned about it now is because our credit reports expire after 120 days. And sometimes it takes more than 120 days for a buyer to find a home. So what we're trying to do, or what I'm trying to do, is wait as long as we can in this early stage of the pre-approval process to pull the credit. They're getting documents in, they're just kind of thinking about it, they're going to their first couple of open houses. We take them at their word. They've looked at Credit Karma, they've looked at their credit report, looks good. To get them out there and get them shopping, and try not to pull until we know that they're really serious. There are plenty of lenders who pull credit the second people walk in the door because they want to know what they're dealing with. It's much easier to just rip the Band-Aid, pull credit. But if someone's got really solid credit and we do that, if it takes them more than 120 days to close on a property, then I'm pulling their credit again. And that second credit pull more than likely is going to lower their credit score. So just something to be wary of with new clients. We use
Matt.
Yeah.
Matt, I'm sorry to interrupt. So are you asking the consumer if they know what their credit score is?
Yeah, in my initial conversation, some people know. They're like, I have a 780 FICO score. I've got excellent credit. And so I take them at their word. I have a conversation with them and the realtor that there's some margin for error right now, but I'm comfortable with a 780 that we're going to be in okay shape. If someone comes in and says, I think I might have a 650 credit score, well, that's a different conversation.
Right.
Let's rip the Band-Aid. Let's find out, because if you're not quite a 620, if it does come in significantly lower, well, then our first step here is credit repair. And making sure that you've got that in line first, because I may not have a mortgage for you. So it's case by case. It's a great question. But if someone's got a 780 and worked their butt off to have perfect credit, the last thing I want to be doing is the guy who lowers that score. Just because there's, sometimes they know there's not a single house on the market I like. I just want I want my ducks in a row. Just because I'm organized. And that's why I have a 780 FICO score.
Yeah.
So
Brian,
next,
Brian,
yes.
can I ask a question on this? Why is it that if someone checks your credit score goes down, if nothing is done other than that?
So the first credit pull doesn't really have a massive effect. It's to prevent people from pulling like several times a month, 15 times a year, and just shopping. Those are the habitual credit pullers. So they give you like an allowance in a year. One credit pull year shouldn't really have any effect. So 1 year you buy a car, 1 year you buy a house, 1 year you apply for that new credit, once a year you apply for a new credit card. That shouldn't have much effect. Why? It's a preventative measure to keep people from just kind of going poopy.
Okay, so there's, I mean, the only reason they lower your credit score is they don't want you checking that credit score 5 times a week.
Yeah. Yep. Because we all know there are people who would. And so this is the measure that they've put in.
Okay.
So when it comes to credit, it's the way we structure credit and credit scores in this country is not perfect, I think is the most appropriate thing I can say on a recorded call. And this is one of these measures that they've put in. Is it the perfect measure? I don't know. A lot of what the credit companies do, is kind of beyond me sometimes. They're not necessarily working for the consumer in what they do. So that's credit. So that's pillar one, is the credit score. So that's the first topic of conversation. We come in, we've got to make sure that they've got solid credit to come in. And then the next thing we look at is your debt to income ratio. What this looks at is how much money is coming in every month, and then how much is going out the door every month. Everything that we do in the mortgage industry is monthly. Mortgages, when we qualify based on a monthly payment. We look at a monthly income. We look at your debt, we look at your income, and we then formalize your debt to income ratio. So how we do that is we look at your gross, not your net, your gross income. And then we take away these are the most common monthly debts. We take away these, and what's left, we have to work with for your mortgage. So the things that we consider are credit cards, car loans, student loans, and then alimony and child support. So alimony and child support is the only one that doesn't show up on the credit report, but we do need to debt you for this monthly payment every month. So what's left from here, we then can incorporate into your house payment. And in your home payment, we look at PITI, your principal, your interest, your taxes, and your insurances. Now I say insurances plural because there are or can be multiple insurances. The one that's the most common is your homeowner's insurance. On any single family house, you have to have homeowner's insurance if you want a mortgage. We also have private mortgage insurance, PMI, if someone has less than 20% equity. And then there are also flood policies, other types of policies that may come into play as well. So when we look at your debt to income, we're qualifying you with all of these debts, and then your PITI, principal, interest, taxes, and insurance. So this basic rule of thumb, another pie chart to show you. Ideally, we like to see 43% of your 43% as your debt to income ratio or below. So when we look at all of these things combined, car, student loans, and the mortgage payment, we want it to be less than 43% of your gross monthly income. Now, who picked 43%? Not me. Fannie Mae, Freddie, they've decided that this is a comfortable number because of your gross income, some goes to taxes, and then some goes to life, right? Your gas, your food. So they know that not all of it can go to these said things here. There is an allotment to live on. 43% income, 43% debt to income ratio is high for many people. A lot of us don't like our debts and our total monthly to be that high. It's uncomfortable. But there are people who live very simply. And so this is the number and the ratio that Fannie Mae has decided, Fannie Mae, Freddie, the conventional guidelines have decided that they're comfortable with, and qualifies as a good, safe number for a consumer. Any questions on that?
So that number would not include the fact that you're paying $1,200 to Comcast for all of your, stuff.
Nope. Doesn't get into health insurance, which can be very expensive. Doesn't get into any of your Comcast streaming. It doesn't get into your car insurance. So that's why it's only 43% of your income. They're leaving a big number left for these other life
Okay.
expenses.
Okay.
This rule of thumb is a great rule of thumb for you guys. The average American uses about 28% of their income when it comes to their mortgage. So we can calculate this, or you could calculate this for a client. So someone tells you, you got new clients and you're like, I wonder what they could afford, without asking them their financials. And you say, okay, she's a teacher, he's an electrician, I think they make about $150,000 a month. You can use this calculation to get a ballpark for what the average American in their position would spend on their mortgage. What you do is you figure out how much they bring in every month. So this one, they're using a $60,000 income. And they look at the monthly, and then they multiply it by 28%. 28% is an average of what Americans spend on their mortgage. So I love a good mortgage hack. So if you're gonna, snapshot this, take a picture of it. It's a fun, easy way to kind of rip through on your calculator on your phone and figure out ballpark what's a good, comfortable monthly number.
What does that number go up to? I know 28 is like the average, but a lot of programs are higher ratio, right?
Yeah. So this 28% allows for quite a bit of the rest of their income to then go to their car payments, their student loans, and the rest of it. This would allow, you've got up to 43%, but what we're showing here is that the mortgage itself, when people are looking to buy, is about 28% of that gross income. Does that make sense? Good explanation, Scott?
Yeah, I guess what I was getting at is, I know there are certain programs that allow you to have a higher front end ratio.
Yeah, we're going to jump into that in a second. Yes, there are programs that allow for higher than 43%. I use 43% because it's the most common, and it's what follows conventional guidelines. So the caveat to this statement is that this is a conventional rubric, and conventional being Fannie Mae, Freddie Mac. When you see your conforming or conventional 30-year fixed rate, it would fall into this category. Separate loans would be VA, FHA, USDA, or anything that's brokered to a specific bank. So, good question. So to break out PITI, the principal is the payment that someone makes every month that actually goes to paying down the debt. So when you look at your first mortgage payment, you've got 360 months left to pay. The first payment, you spend a lot more on interest than you do on principal, because as you write those mortgage payments, a lot of it is going to the interest. Basically, you're paying back the bank what you are borrowing from them. So when people talk about their mortgage, it's really those two things, the principal and the interest. The next part, which we usually collect, most people collect their taxes and insurance as part of their mortgage. The taxes, every month you pay into the escrow account. So when your quarterly taxes are due, the bank can just pay them for you, goes right to the city. Homeowners insurance, very similar. Most of these programs, if you put down less than 20%, they require you to escrow your taxes and insurance. Once you own more than 20% of your home, it's your prerogative, you can pay them separately. But the banks do like the control over the taxes and insurance. It's, if you think about lending and banking, it's all risk management. If they have 3 months of taxes and insurance sitting in an escrow account, they know that if you forget to pay your mortgage or decide not to pay your mortgage, they can still pay the quarterly taxes. They can still pay some of the homeowner's insurance. Not surprising, they've collected 90 days worth of taxes and insurance. They can't foreclose on you for 90 days either. So nice little, cover your butt scenario from their perspective. They've got enough to pay in the time if you decided you were no longer going to pay your mortgage. So we talk about down payment, and that's the next one. So I'm going to break out a little bit here. Down payments can range anywhere from 3% to 20%, but then there's closing costs. So I'm not going to dive deep into 3% to 20%. You guys, especially you, Liz and Nicole, I think you get that check just gets given to the attorney. I get a lot of questions about the different types of closing costs. I don't know if you've done this with an attorney. Attorneys are very good at breaking these down too. But this is from a closing disclosure, and it goes through and it breaks out, property price, closing costs, and, okay, so I'll go a little bit slower. The sale price of the property was $550. The closing costs on this property were $7,881. So in the closing costs, we have the attorney's fees, the lender's fees. We collected 3 months of escrow in this. And so they line item it and button it all together so the client can see it nice and clearly on the CD as a summary. This one gets a lot of questions. Adjustments for items paid by the seller in advance. What this is doing is this is accounting for how many days of the month the seller owned the property, after you've moved in or before you've moved in. So there's an adjustment, and on this one, it was from 12/27 to 12/31, where $63 was accounted for the taxes during that time. So this is a very common per diem fee that people are questioning, like, what's this little ticky-tacky fee that you've got here on your summary? It's a per diem for the taxes added to the closing disclosure. Then it breaks out the deposit separate from the closing disclosures, the loan amount. And in this scenario, we gave the clients a seller credit. And I specifically picked this closing disclosure to show you what it looks like. This $1,750 was a credit from the sellers, which you guys are all familiar with. This one, I think it was a water heater, needed to be repaired. And so it shows right here as a line item. And then break it out, closing costs paid at closing, and then the seller credit, you get your total here, and then the from and the to. So those breakdown of what to see in a closing disclosure. I don't tend to dive too deep into it because honestly, the attorney is probably the best one to go line by line. A lot of the fees in a closing disclosure are from the attorney. They get into taxes, they get into their mortgage lien certificates, and the different breakdown of the attorney's fees and lender's title. I'm going to avoid that and stick to just the financing part. So when we talk about financing, I'm moving away from kind of the qualifying to talk a little bit more now about the two most common types of loans that we see in our market, which would be conventional loans and FHA loans. I think we will see, as interest rates start to rise for conventional loans, we may see some more FHA loans come into play because they may have better interest rates. And so as this trend of upward rate continues, we very well may see some more FHA loans come in. So conventional loans are traditional. They typically require a higher credit score than FHA and USDA. So right now, we can go down to 620 with conventional financing, but ideally, to get the most bang for your buck, let's call it, we like to see credit scores over 680 and then even better, over 720. They're pretty flexible in terms of their guidelines, in terms of reserves and gifts from parents and kind of the structuring of what we do on the back end. Conventional loans, because you've got good credit, because you've got a steady or solid down payment, tends to be a little bit more flexibility. But they have stricter income requirements. Goes to Scott's question. Are there programs that allow for higher debt to income? Yes. These conventional loans, ideally, we like to see it under 43%, and we do have some room up to 45 or even 49%, depending on the down payment, depending on the credit score. These are Fannie Mae and Freddie Mac loans. That's what gives the conventional term. The next loan type that you see most commonly is FHA, Federal Housing Administration loans. Right now, or over the last couple of years, we haven't seen as many. And the reason we haven't seen as many, especially on the listing side, is because we're seeing the stronger buyers get their offers accepted. In such a competitive marketplace, the 3.5% down FHA buyer is not as enticing to a seller as a 20% down buyer. So FHA has not been as prevalent in our marketplace up here in northeastern Massachusetts, but I think we may see some more. Typically, FHA loans are utilized with lower credit scores or lower down payment. So if you're 3.5% down or you've got a sub 680 FICO score, the math often looks better when it comes to the monthly payment for the consumer than a conventional loan. So that's the math we do here. We look and we say, okay, conventional loan pricing's at, or the interest rate's at 3.5%. The FHA loan's at 3.25. And they're different day to day. So I'm going to talk to the client and say, hey, this FHA loan is going to save you money every month. Let's use this and see if we can get the offer accepted with an FHA loan.
Matt, I'm just curious, does PMI cost more for FHA versus conventional?
You are always like a slide or two ahead of me. Yeah.
I'm sorry.
No, it's the perfect question because I'm going to lead right into it. It depends. When you're in the lower tier, I'll show you. I've got a slide that'll show you when you're in the lower tier of lower tier of credit score. Often FHA PMI is better. Higher tier over 720, without question, conventional PMI is going to be less expensive. So it's a balancing act, and PMI companies are like any other insurance company. We've got our own version of Geico, Allstate, Progressive, the General, and they're all competing over this market. So the rates change for PMI based on the appetite of these different insurance companies. We've seen PMI for conventional financing come down quite a bit over the last year and a half. Why? There's been a ton of volume in the mortgage industry and they want it. So it's a volume game. We watched PMI come down because the volume's going up and they're competing over this market. So it was kind of a race to the bottom a little bit. So with good credit, PMI is definitely less expensive with conventional, but with lower FICO scores, FHA tends to have lower PMI. FHA loans have a set PMI rate. I'm jumping kind of ahead, whereas conventional loans vary based on your down payment and your credit score. And I'll show you an example in a second. So to go back to FHA, FHA loans, the biggest differentiator between the two is the PMI. And FHA has fixed rate PMI, but it also has a mortgage insurance premium that you have to pay up front. So you have to pay for insurance. You front load your insurance when you get the loan. And there's no way to get around that. And so ideally, we like our clients to avoid that, right? I mean, no one wants to pay an insurance policy for someone else if they don't have to. So that's often the push to get them into conventional loan. But like Scott said, what's more important, the lower payment every month or avoiding that upfront cost? Some people don't have the option. They've got the lower credit score and this is what they have to work with. So a little bit deeper down here, conventional financing allows for as little as 3% down. Gift funds allowed. no minimum contribution. The Bank of Mom and Dad is the 7th largest lender in the country. The Bank of Mom and Dad can write a check, no big deal. We get a gift letter and we drop it in the file and we show that the money hit the account, no big deal. You can get seller concessions. That's why I add that lender credit up to 10% of the down payment, or 3% of the purchase price is the maximum here. If you've got less than 10% down, more than 10% down, you can get up to 6% seller assist. So these are good numbers to know. If someone's got less than 10% down payment, they can only get a 3% concession from the seller. More than 10%, they can get 6% from the seller. The rates and the PMI are dictated by the credit score. That was one of those big differences I just mentioned. After you drop below 740, sometimes 720, you start to see rates come up, PMI come up. This loan level pricing adjustment, that's how we price out mortgages. Every 20 points, we see adjustments. So under 740, we start to see this adjustment, which means rates go up. So debt to income, back to Scott's question, debt to income ratios are not as flexible. It can be as a hard stop at 43, depending on the loan itself. The PMI may be more expensive, but the nice thing about conventional financing's PMI is that it disappears once you own 20% equity in your home. FHA PMI stays. So FHA financing, 3.5% minimum down versus the 3% on conventional. Gift funds are allowed. You can get up to 6% from the seller. Doesn't matter your down payment. And credit scores, that lower credit score does not affect the interest rate as much, especially under 740 or 720. Debt to income ratio are more flexible. They allow up to 50% of your gross income to go to debt. It's a big number. And oftentimes we see, especially with single households or single borrowers, we need all the room we can get. Oftentimes we'll put one client or one member of a couple on the loan and not put the other one in. So we're really pushing to maximize what they can afford. Sometimes that extra, little bit on the debt to income is a huge help. So the PMI, the mortgage insurance, is more expensive than USDA loans, but maybe less expensive than conventional loans based on the rate, and it remains on the loan forever. It doesn't just fall off. What people then tend to do is then refinance as their home value appreciates or as they pay down their mortgage and get themselves into a conventional loan. FHA loans were never designed to be forever loans. They were designed by the Federal Housing Authority to help people get into homes, to enable home ownership. So it's stage one of home ownership. That's why all these guidelines are flexible. Back, years ago, it was the only game in town that allowed for 3.5% down. These other lenders, Fannie and Freddie, have adopted since then. But the idea with an FHA loan is to help someone get in and helps with home ownership. But it does come with its downsides. It does have that upfront mortgage insurance premium that you have to pay. And you can roll it into the loan. So you don't have to pay it out of pocket. You can roll it in and pay it back every month. So that's kind of the deep dive on those two. Those are the most common. I didn't want to bore you getting into USDA loans. We don't do a ton of them. VA loans are very similar in structure to FHA loans, but they allow for 0% down and have no MI. VA loans, I get on my soapbox every time. If you get a VA loan and you're a listing agent, it should be the first offer you look at. Oftentimes it's the last. The optics don't look great, right? It's a 0% down offer. You might have cash offers. You might have 20% down offers. But these are veterans. These are people who served our country. Please talk to your sellers about a VA loan. Just because it's 0% down does not mean that they don't have any money. It's their entitlement for serving. If you ever have questions when you're listing on a VA loan, call me. I think we should all work to get our vets into houses. I'm hearing a lot of veterans feel like they can't compete with their VA loans in this market and have asked to switch their VA loans to conventional loans because they feel like they can't get their offer accepted. This tight inventory world that we're living in has made it tough on them and tough on VA loans to get accepted. So that's my soap.
I agree with you, Matt. I think it's horrific.
Yep.
That
And it doesn't mean that they're not qualified because they
no, right.
It just means they're eligible. It's their they don't get a ton of perks, right?
No.
So that's my Liz and Nicole, that's my soapbox of the day. So we talked about conventional, we talked about FHA. USDA loans are rural loans. We don't have a ton of rural space around here. We're out of space. Go drive through Marblehead. We're out of space. I won't dig into that. If anybody has a rural property that they want to talk to me about, we can very quickly unpack this. VA loans, similar guidelines to FHA. Yes, you have to deal with chipping paint. Yes, you have to have railings. I'll go install a 2x4 for a railing if you need it and run over with a coat of paint if it means getting a vet a house. Renovation loans, there are many kinds of renovation loans. This is like a topic in itself of renovation loans. I'm getting tons of questions about renovation loans over the last year and a half because with a competitive market, everyone's looking at how do I get in? How do I get my edge? 203K loans are the most common traditional type of renovation loan. Those are through FHA. They have quite a bit of requirement in terms of you're underwriting the construction, you're underwriting the client, and then you're dealing with the appraisal of the house like you always do. So instead of a two-part process of just the client and the house, now we've added construction. So it does take a little bit more time. You need a general contractor to submit a bid to get these done. You need a general contractor on board. If anyone wants to talk to me about renovation loans, please call. It does take quite a while to break through each one of these. I am not a renovation loan specialist. We have one on staff. Scott, if you want to do a renovation loan presentation, let me know. I'll bring in our renovation loan guy.
I don't think it's a bad idea. We'll do that in the future. I think it's a good idea.
And the last one that I want to talk about is mass housing. Mass housing is our state program that is flipping phenomenal. We are so fortunate in this state to have mass housing. Mass housing is a first-time home buyer or an affordable housing program that follows conventional guidelines, which is great. It's the best case scenario. Follows conventional guidelines. They offer down payment assistance. They offer a small discount or can offer a small discount on PMI. We're really fortunate. If you know anyone who's in that first-time home buyer niche, this is absolutely worth looking into. The one thing to keep in mind with these programs is they have an income limit. And so if you make more than the income limit in the given town or neighborhood, you may not qualify. Again, this is one of those, it's town by town, area by area. More than likely it's 114,000 and their next step up I think is 136,000. So if you've got someone who fits that bill, I would love to talk to you about mass housing. We're really fortunate state program. So
yeah, real quick.
Yeah.
That mass housing program, those income limits, are those the total for the applicants, or is that per individual?
Total household, and it would be both people on deed. So even if someone's not on the mortgage, we do have to consider their income. That's pretty strict.
Now I also heard a couple other things about the mass housing that I'd love for you to confirm.
Yeah.
One of them was related to if you lose your job, it has like an insurance caveat.
Yep. They give you 2 months.
Was it 2 months? Up to 2
Yeah,
months?
so they have a like a forgiveness program. If you can show that something happened, losing your job or getting in like a really bad injury, and can't make your mortgage payment, you can reach out to them for forgiveness. Very similar to what the national lenders did during COVID, which they called it forbearance. They'll give you a break and work it out with you, how they're going to handle it after that.
That's great. And I also heard that they do, what is it? They allow you to use the money for fixing a home that either has a failed septic or has lead paint present. Is that true?
Say that again.
So they allow you to use like it's got like a rehab feature to it that you could also use to fix either a failed septic or to de-lead a property with lead paint.
Right. So they have, it's not a true construction loan. It's like it's structured like a second loan, almost like a construction loan, to mitigate a serious repair. De-leading, septic, I think anything that would go to the safety of the home, not a hot tub.
Not a so you'd have to use like the FHA 203K program for that type of thing.
Right. I don't. Yeah. They're not going to let you put in a hot tub either. But
no.
with an FHA 203K loan, you can redo your backsplash. Right. You can put in new cabinets. This is not for cosmetic. A 203K loan is a construction. As long as it goes to the betterment of the home, you can use it. This Mass Housing's program is very specific with, it basically needs to be a health risk or a livability risk.
I gotcha. Yeah, the only experience with the 203K rehab was this gentleman I had been working with for a couple of years. He ended up wanting to live in a certain school district, and the home that he found that was within walking distance was a ranch, but that was far too small for his family's needs. So they actually put a second story and converted this into a complete colonial, which I thought was phenomenal that he was able to do that.
In 2018 and 19, I did quite a bit of them. But as the market's gotten more competitive and builders have gotten so busy, they've been harder to get accepted. The trick or the toughest part with a 203K loan is the general contractor has to submit a bid, and then we'll get paid out in phases. Well, in order to get paid out, FHA sends out a HUD consultant. It's basically like an inspector that says, okay, phase one is done. They go through, they say, yep, this looks good, this looks good. Okay, general contractor, here's your check. Phase two is done. They go through, check the boxes, here's your check. Well, if you know any general contractor right now, they can't keep up with the work. They're going to get 50% up front, go bang out the job, and when they finish, they're going to get 50% and move on. And no one's going to look over their shoulder, double check their work. They're going to do what they're going to do. They're going to get in, they're going to get out.
Right.
That's the tough part right now with 203K loans.
Yeah, and they take longer, like you said, because you've got to get that whole construction phase built into it. Yeah.
They're tricky. They have their time, and when they do, they're unbelievable. It's getting them accepted and getting a general contractor on board that's the tough part right now.
Wow.
All right. So here's a little PMI deep dive. I told you I was going to show you how to get and do your own PMI, and I'm going to show you some numbers here. These are just estimates. I know I'm being recorded, but just a disclaimer there. So USDA loans, that's the rural loan. All right. So upfront, they charge 2%, and then the monthly premium is 50 basis points. FHA charges 1.75% of the loan amount up front. And then typically it gets rolled into the mortgage loan amount. So you pay that 1.75 as part of your monthly payment. Conventional loans, no upfront. The monthly premium here you see though is fixed. 0.85. That's it. Doesn't matter your credit score. Then we jump down here, and this conventional shows kind of a breakout. These are, rough numbers, no upfront. And with 3% down, it starts here at 1%. So maybe FHA is better. Maybe. These are probably a little dated. We might be able to do better. But as your credit score goes down, 760, 720, 680, 660, you watch this premium go up.
Goes up, yeah.
But you watch as your down payment goes down, as your down payment goes up, this PMI goes down, right? So if you're going to put down 85%, or if you're going to put down 15% and finance 85%, it's a really low number, really low. And especially with good credit. I really like financing with 15% down, because the PMI can be like $85 a month. And
Right.
on a large loan, and 5% on some of these home values around here is a boatload of money, right?
Yeah.
Think about a $700,000 purchase. You pull back 35 grand. Well, you can redo your entire patio. You could put in all new windows. And yeah, you might be paying $80 a month in PMI, but it's a given
sweet spot. That's like the
Right.
sweet spot. Yeah.
Right. I love it.
Wow.
So here is how you calculate it. All right. So here's an example. $600,000 purchase with 5% down. Okay. So they're going to put down 30 grand. Shoot, I didn't update this. Whoops. I had this at 300,000. I upped it because the home prices have gone up so much. So ignore my 18 here. $570,000 loan amount. And the mortgage insurance premium factor here is 0.54. So what we do is, this is 54% of 1%. It's 54 basis points. So when you get out your calculator, you do 0.0054 times the loan amount. And that's how much the annual premium is. Then you divide that by 12, and you land at $256 a month. So when we show these, if I go back here, we show these, this percentage. You take this percentage, multiply it by the loan amount, and then divide it by 12, because they're paying it over the course of every month, 12 months in a year. This gives you the annual cost of the policy. Everybody follow?
So you're doing 0.0054.
Yep. 570, I'll do it with you. 570,000 times 0.0054 is $3,078 a year, divided by 12, $256 a month.
All right. So I just want to copy that example down if I could.
Now, I've seen PMI policies, to go back here, I've seen PMI policies with 15% down now at like 16% of 1%, 16 basis points. 800 FICO score, 15% down. We're talking in a loan amount like this, like $80 a month.
Yeah. Yeah, it's worth having an extra 35 grand in the bank,
right,
for a month, right?
Right. So moving on, this is where I talk about kind of best practices. We're approaching an hour here. These are two different pre-approval letters, and in the last 4 weeks, interest rates have gone up 0.94% through Fannie Mae. So roughly 1%. So they went from just over 3% to just over 4% in the last 4 weeks, since January 7th. What's happening here is a lot of lenders have approved people before interest rates went up. So someone who was approved at 3.25 or even more, like in November, December, rates were at 2.875. A lot of lenders write to be determined pre-approval letters. I want to show you the difference between a to be determined pre-approval letter and my typical pre-approval letter. The biggest difference is this, the address. Every pre-approval letter I write has a property specific address because I've reviewed the property address and approved that specific property. Well, why is this important? This pre-approval letter is October 6th, 2021, and it's to be determined. Well, what's happened since then? Rates have gone through the roof.
Yeah.
What's this pre-approval letter? That's today's date and the address, for Carl and Carla Carlton, 345 Sunset Boulevard in Carlisle. I think I'm cute. So as a listing agent that I've looked at this, right? When rates go up like this, the increase of interest rates on a larger property like this, we're talking several $100s a month, almost $400 or $500 a month in monthly payment that may not have been re-reviewed. This is going to be a massive issue throughout the country right now with this massive quick swing in interest rates. So I think best practices, whether you're a buyer's agent on a transaction or you're the listing agent, make sure that these are specific and make sure that they're signed, make sure that the date is accurate. See, this one says, this pre-approval is subject to identification of a subject property, if not previously identified. Well, what if this property is in the haunt and has flood insurance for $500 a month? Like, did they qualify that? I hate generic pre-approval letters. It stinks. My Sunday nights are dedicated to updating these, but that's the nature of the beast.
Yeah.
All right. So that's just one thing I wanted to point out, kind of Mortgage 101 from my perspective. Check those. This is the new normal. And if anybody wants to talk about this competitive marketplace and waiving all of these, this new marketplace has put a lot of strain on lenders and on you guys as well. But in terms of getting us to the finish line faster without contingencies, is everybody, I mean, I can dig into each of these, but a waived appraisal, unless you have confirmed as a listing agent that they have the cash to make up the difference, unless you've gotten proof from the lender ahead of time that there is a property inspection waiver, the bank is still going to do the appraisal. What you're saying in that offer is that we're going to buy this house regardless of what the appraisal says, which is fine. But how? What are you going to do if this appraisal comes in 50K low or 20K low? What are you going to do? Are they going to come up with cash? Are they going to change their financing and finance more? If you're going to accept something that has these waived contingencies, especially the appraisal one, ask how ahead of time. Don't find out 3 weeks in when the appraisal comes back that was waived, and there all of a sudden there's a giant shuffle. Waiving inspection doesn't have a ton to do with me. Waiving financing. Waived financing is my biggest pet peeve because I still need to go through the process. I still need to do this, even if it says it's been pre-underwritten and I've done it 1,000 times. If someone gets hit by a bus, this could fall apart, right? And they could get laid off. If financing is waived, the seller gets to keep that money in escrow, right? That's the golden nugget. That's the pot of gold at the end of the rainbow, that if their financing falls through, you get to keep that 5% deposit. I don't know anybody who's actually got to keep all 5% of that without going to court. And while you deal with going to court and figuring out if you're actually going to get that money back or if you're going to get to keep it, you can't relist your house. So it looks great. The optics of it are fantastic to say they're waiving their financing. Well, what happens if it does still fall apart? if you're the sellers, there's no guarantee that you get to keep that money.
Right.
And you can't relist for quite a while. The only waived financing that I like is if someone shows proof of funds that they could legitimately buy it in cash if the transaction falls through. That to me, that's waived financing. Otherwise,
I agree.
you're taking on a risk and you're telling your clients that, oh, they've waived financing. We're all set. And if it goes south, you get to keep the 5%. Yeah, after you've gone through probate court. And they can't relist the house. What's going to happen is you're going to settle and you're going to give some of it back. You're going to keep some of it and everyone's going to move on and everybody's going to be frustrated. This this one's my new favorite. Have you guys seen these listing agent questionnaires sent to the lender?
Yeah.
I don't really know how I feel about it. It is what it is, but I'm filling out questionnaires about things I can't answer about clients. It's all confidential and they want to know details of what I think the likelihood is of someone losing their job. Just be careful with these, don't push too hard. And then shortened timelines right now are seemingly fine. We're running as fast as the appraisers are running, which has gotten much faster in the last 2 months as inventory has gone down and refinances have gone down. There was a time, you all know it, when appraisers were running around 4 weeks, maybe even longer. We're back down to less than 10 days. So it's great. 10 days, a week, 5 days, depending on the area, the market. Understand, the further you are out in the world, away from the metro area, the longer appraisers tend to take. Appraisers like to go do several inspections in one day. If they can stay in Salem and never leave Salem, they're going to stay in Salem. If you send them out to Stoughton and they're going to push that one back and they're going to, that one's going to take a little bit longer. So know your market, talk to your lenders, and we can always pay a rush fee. And it sounds super expensive and super hard to do. We can typically motivate an appraiser for about $300. And so if you really want to get this done and you're the agent, just call your lender and say, hey, how much is a rush fee going to be to get this thing back in 4 or 5 days? Maybe it's only $300. I'll pay it, split it. Talk to your client, say, how badly do you want this? It's $300. You're overpaying on the house anyway.
Anyway, right?
So there are ways to shorten the timeline. Have the conversation ahead of time. Talk to your lender. It's going to be important in the next few months. So that's my tips on those contingencies. The buyer psyche. I mean, I'm front lines dealing with buyers nonstop. A lot of our buyers are beat up. They've been kicking around. They've been, they've had their credit pulled several times. They put in multiple offers through multiple seasons. Just be empathetic. I have a lot of clients who are on their second spring. And, home values are up 13% in Essex County since when they started. So just be wary of that. Yeah. How do I do a construction loan? We talked about it. I've been getting that question like crazy. Everything in my price points gone crazy. How do I do a construction loan? This is happening almost every week. And I love this. We've increased our search to include New Hampshire. Like I get that one once a week. Like, all right, Beverly's no longer going to do it. Now you're in Rockingham County. All right.
Wait until they say like Vermont,
Yeah. Well, and I also say to them, I said, have you looked at taxes in New Hampshire? And have you looked, at the income tax? Have you looked at the property tax rates? Yes, you get more bang for your buck, but at the end of the day, monthly, sometimes it's not that much cheaper. Yeah. Look at Rockport. Rockport's got the lowest taxes, and you may as well be in New Hampshire. I don't care if it doesn't appraise. We heard this a lot last year in the spring and the summer. The last few months, I haven't heard this as much, but we're about to hear it again. Appraisers are looking in the rearview mirror where all of us are looking forward. Appraisers have to use comps that are within the last 6 months. We are typically in a depressed market. Seasonality comes down. Great statistic. Median home sales price in Essex County for January was $575,000. Median sales price for homes in Essex County in June was like 660. So $100,000 spread between June and January. Well, the appraisers are working backwards. If the comps that they have when they, are working in March are all this depressed number, we will potentially see low appraised values. It's the bane of increasing market, early spring market. We're taking off, appraisers are looking behind us. So we'll see how it pans out this year. The last 2 years were hectic. So finally, just some best practices stuff from a lending perspective. We all know that in an environment like this, it's all optics. You spread out 6 offers on the table. You're the listing agent. All right, which one's the best? Well, obviously the cash offer, the top dollar amount are at the top. But if you're financed, what can you do to get a creative edge? Shorter term fixed rate letters are awesome and an unbelievable way for me to tell a seller that my clients are incredibly well qualified without telling them any real details. So what I do is if a client can afford a 15-year mortgage, I put 15. This client is pre-approved for a 15-year mortgage on this property. Well, what does that say? That shows that they've shortened the timeline. The monthly payments through the roof. Scott submits the offer. He gets to call and say, these guys are approved for a 15-year on this. They're super solid. Look, they're going to get a 15-year mortgage. That in itself is a reason to talk to the seller and a little, just to put it out there, that gets them to think, oh, wow, all right, so I'm going to move this one over to the side. These guys are really strong. You don't need to put out appraisal language, in my opinion, if the pre-approval letter has appraisal language in it. Talk to your attorneys. I've talked to Tim Shea about this in the past. My pre-approval letter says subject to pre-approval. I don't personally know that you need to put it in your offer language.
You mean subject to appraisal?
Yeah.
Yeah.
My pre-approval letter, all pre-approval letters should say subject to appraisal, right? Unless it's already been waived, but at time of pre-approval, you wouldn't know. So you don't need it. Don't point it out. Leave it alone. It's going to get hectic again, I imagine, in the spring with appraisals. It's in the pre-approval letter. Just submit it. Don't talk about appraisals. Make sure your pre-approval letters are address specific, date specific. I follow up every offer with a phone call. So Nicole knows I'm going to submit an offer on Sunday night. Matt shoots Matt a text. Matt, I just submit an offer to Scott's listing. Can you call Scott and tell them how wonderful everybody is? I do. Part of it all. I call, hey, Scott, Matt Blanchard from Academy Mortgage. And he looks at his phone on a Sunday night at 7:30 and says, why the hell is there a mortgage guy calling me right now? And I say, just so you know, Nicole submitted an offer. You got a pre-approval from me. I've reviewed everything. Love this house. Look through the pictures. The patio is wonderful. Here's my cell phone. Let me know if you have any questions. I'm sure it's competitive. When you're sitting with your sellers, if we're in the top 2, don't hesitate to reach out about financing questions. I will make this as competitive as I can with closing times. And the best part about that phone call is if I get the listing agent to talk to me, they often give me more information than they're supposed to. It's unbelievable because you just kind of start conversation and then she says, oh, honey, well, you're not the top offer, but I really appreciate your phone call. I had 11 offers on this and I had one that's cash, but the cash one's not as high as the other one. And you never know. So that phone call is reconnaissance as much as anything else. And so it gives us the opportunity, if we submit it on a Sunday night, to reevaluate Monday morning, talk to our clients. I love the lender phone call. It's amazing what you can find. Contingencies are the scourge of our industry right now. I've spent a lot of time, especially for downsizers, working to see if we can use retirement assets to help people qualify for their next mortgage. The most important thing we can do as a lender is to exhaust all options when it comes to financing. Well, more importantly, if someone's trying to move without selling first, exhaust every option to see if we can write that offer non-contingent. The downsizers are the biggest struggle because they say, oh, I'm on fixed income, I have a pension, I can't afford this next mortgage. But we look at the spouse's 401k, they've got this big pile of cash that they haven't touched yet, so they don't actually consider it as income. Well, we can use retirement assets as income. And it is an unbelievable tool to add income to their debt to income ratio and maybe write this offer non-contingent on the sale. I've worked out a whole bunch of these over the last 6 months. And then you're potentially getting a listing and a buyer. So contingencies with downsizers, especially retired people, are hugely important to look at. And then contingencies in general, just to say, is there any way, shape, or form we can get this client to buy their next house without having to write in the pre-approval letter that it's subject to the sale of their home? Exhaust all financial options, look at worst case scenario, because we know that as soon as we put their house on the market, it's going to sell. So we're going to put their house on, they're going to have the cash. We just have to figure out a worst case scenario if it doesn't. So exhaust contingency options. And then finally, figure out how quickly everybody wants to close. And if you want to close in 3 weeks, talk to your lender, pay that rush fee, we can get it done. Today. I don't know what it'll look like in June, but and that's it. That's my mortgage 101.
Nice. Great information. I appreciate it.
Yeah, the stuff at the end I think is more fun than the basics, but I never know who's going to be on the call if we really do need to dive deep into how we structure financing. So
Yeah, Liz and Nicole, I'm not sure if you're still there or not, but if you guys have any questions, feel free to fire them away.
No questions. I'm glad that you mentioned that last part about the retirement, people qualifying who are retired and may not know that they can use their 401ks or whatever for qualification.
yeah, I mean, most people.
I have one of those, and I may be giving you a call with them.
Oh, please do. So the tendency with 401ks is that no one wants to turn that faucet on too heavy, because once it's empty, right?
Right.
So everybody's conservative with the income that they turn on in retirement. So we've got some Social Security, we've got some 401k or IRA distributions. But in this part of the world, there are a lot of people with very, very large 401ks or IRAs, retirement assets that are just, bless you.
Sorry.
What Freddie and Fannie will do, Freddie in particular, will look at an entire retirement portfolio and they divide it by 240 months. Basically saying, if we were to stretch this and make one payment every month for the next 20 years, we'll use that as income. So you can take, we can do it right now. If you looked at $1 million 401k and broke that out for 240 months, that's $4,167 in qualifiable income.
Okay.
That's a boatload of money to add to someone's income. That's like adding $50,000 a year to someone's income.
Right.
And so does that 50,000 then give them enough to buy their house without selling their existing? Don't know, but definitely worth digging into.
Great.
It's
Thanks,
that,
Brian.
you got to get them off the fence.
Thanks, Matt. I've got to go. Speaking of that particular person, meet with them. So
Good luck.
thank you for the presentation. It was quite good.
Good.
Quite good.
Thank you. Thank you.
Take care.
Thanks, Liz.
Bye, Liz. Come.
Bye,
Oh, Liz,
Yeah.
I just started doing market updates once a month. Those are a ton of fun. Scott, you were on the last one. I think
Yeah.
I would, if you're around, jump on the next one. It's in 2 weeks. We talk about everything that's going on in the market, financial
Okay.
markets and the real estate market.
Great. I would love that. I will. See you
Sounds
then.
good. Bye-bye.
Bye.
Bye.
Bye, Nicole.
Bye, Liz.
Nicole, are you in a cave?
Yes.
All right.
It sounds like it too.
At this very moment, I am.
Nicole, how are you?
I'm good.
Good.
How are you?
Great.
You
Thanks
busy? You're always busy.
I'm really busy with things that are not panning out.
Yeah. Oh,
I think the swing in interest rates last week scared a ton of people into making phone calls. And so I worked on a lot of cash out refinances, a lot of people who are just getting with a little kick in the butt, thinking,
Yeah.
oh God, now things are going to be more expensive. I really need to get my pre-approval in. I've had a lot of low FICO score people come in the last few weeks. It's
mhm.
that time of year. People are kind of scrambling, trying to figure out what's going to happen for spring.
Yeah. I think I have a couple people for you in the Beverly area
Sounds good.
who have been kind of on the fence, but are now like, okay, why wait?
Yeah, on this swing. Did you guys, Scott? Did you see, Nicole? Did you guys both see the swing in rates on Thursday last week?
Yes.
Yep.
So what happened? The president of the Fed, his last name is Bullard, Jim Bullard. Jim Bullard,
Yeah.
who is not the chairman of the Federal Reserve, he's the number 2 guy, gets out in public, which is completely unorthodox, and says, I would like to see 100 basis point increase in the Fed rate sheets by July 1st. This is like, does not happen. The Fed does not speak. No one on the Fed ever speaks out of turn. They speak after their monthly meetings, and the chairman of the Fed, Powell, would then have a very, very conscientious approach to how they deliver news. Well, this guy just comes out and he's like, well, I'm going to push for 100 basis points inflation. We got to get ahead of it. We have to take a stand. And what happens? The market repriced 93 basis points instantly.
Oh
And
my
just
God.
went, boom. Well, if you say it's 100, I mean, Wall Street's not out to lose money. It's expensive to live in the Hamptons, right? So they just say, all right, well, we'll see your 100. We'll hold there. And if it doesn't happen, that's fine. We'll pull back. And it just took the industry by shock. And I mean, you watch the market move. Bond yields went through the roof.
Yeah.
And this guy was on the docket to become the chairman of the Fed. And then Biden did not make him the chairman because they wanted to move through all the stimulus stuff that had been going on. So am I still being recorded?
Yeah. I'm not going to do anything with the recording.
Yeah.